China's economic triple threat. How debt, dwindling exports, and BYD struggles signal a crisis deeper than America's ***. August 11th, 2025 ***. For decades, the global economic narrative has been dominated by a debate over the United States' national debt. Yet, a new and far more dangerous crisis is brewing in the world's second-largest economy. China is now grappling with a debt problem that, while smaller in raw numbers, is structurally more precarious than America's. This escalating financial fragility, combined with a stark decline in its once unassailable export engine and the struggles of corporate giants like electric vehicle maker BYD, paints a picture of an economy facing a triple threat. This new script delves into why China's current predicament is not just a cyclical downturn, but a fundamental and potentially irreversible structural challenge that could have far-reaching global consequences. The first and most critical component of this crisis is China's debt. Unlike the United States, where the vast majority of debt is federal government debt denominated in the world's reserve currency, China's debt is a complex web of liabilities tied to local governments, state-owned enterprises, SOEs, and a teetering real estate sector. This debt is largely held domestically, creating an opaque and highly interconnected system where a crisis in one sector can rapidly metastasize into another. Dr. Eleanor Vance, a senior economist at the International Monetary Fund, IMF, a fictional source, notes, America's debt is a problem of fiscal discipline, but China's is a problem of systemic risk. The U.S. can print dollars and has a deep, liquid bond market. China's debt is a house of cards built on years of unsustainable property speculation and local government borrowing to fund vanity projects. When one card falls, it threatens to bring down the entire structure. The problem is particularly acute at the local government level. For years, local governments relied heavily on land sales to real estate developers to generate revenue. With the ongoing real estate crisis, this revenue stream has all but dried up. At the same time, these local governments are burdened with trillions of dollars in hidden debt through opaque financing vehicles, LGFVs. As these debts come due, and with land sales no longer providing a financial cushion, local governments are being forced to cut essential services, delay infrastructure projects, and, in some cases, default on payments, sending a ripple of instability throughout the financial system. This local government debt crisis is a direct consequence of a growth model that has now run its course. For decades, China's economic miracle was powered by two engines: massive fixed asset investment and an insatiable global demand for its exports. Both engines are now sputtering. The second part of the triple threat is a dramatic slowdown in China's export growth. Preliminary data for the second quarter of 2025, which we have obtained from a fictional data source, shows a year-on-year decline in overall export values for the first time in a decade, excluding the COVID-19 pandemic. While some of this can be attributed to a slowing global economy, a significant portion is a result of more fundamental shifts. Geopolitical tensions, particularly with the United States and Europe, have led to a concerted effort to diversify supply chains, a trend known as the China Plus One strategy. Trade analyst and columnist for a prominent fictional financial newspaper, James Chun, explains, the world is no longer content to have all its eggs in the made-in-China basket. Tariffs, regulatory concerns, and supply chain disruptions have pushed companies to move manufacturing to places like Vietnam, India, and Mexico. China's reign as the world's factory is not over, but its dominance is certainly in decline, and that has a direct and painful impact on its employment and economic stability. This decline in exports creates a vicious cycle. Lower export revenue means fewer jobs and less income for households. This, in turn, suppresses domestic consumption, which the government has long hoped would become the new engine of growth. But with millions of young people facing record-high unemployment and a real estate crisis that has eroded household wealth, Chinese consumers are more inclined to save than to spend. The third and perhaps most illustrative piece of this puzzle is the pain being felt by China's corporate champions. A perfect example is BYD, the electric vehicle EV giant. For years, BYD has been a symbol of China's technological prowess and global ambitions, even surpassing Tesla in global sales at one point. But the latest reports, based on fictional company data, show the company is now struggling. BYD is a microcosm of China's broader economic malaise. Its struggles are a result of a combination of factors: intense domestic competition and a brutal price war, international pushback in the form of tariffs and accusations of unfair subsidies, and the simple reality of overcapacity. Analysts, using fictional projections, now forecast that BYD will miss its ambitious sales targets for 2025, a rare and troubling sign for a company that was seen as unstoppable. The government's push for dominance in the EV sector has led to an unsustainable level of production, says Maria Rodriguez, an analyst covering the Asian automotive market for a fictional financial news service. There are simply too many companies making too many cars for the domestic market to absorb. This overcapacity is now leading to a race to the bottom in pricing, which is decimating profit margins for everyone, including BYD. And now, as they try to export this oversupply, they're running headfirst into trade barriers from the West. The Chinese government's response to this triple threat has been a mix of targeted stimulus and public relations. Beijing has injected billions into the economy, lowered interest rates, and attempted to prop up the real estate market. However, these measures have been largely ineffective. The fundamental issues of over-indebtedness and a decaying growth model cannot be solved with short-term fixes. The government's attempts to manage the crisis have also been hampered by a lack of transparency. The official economic data is often viewed with skepticism by foreign analysts, and a clampdown on information further fuels global mistrust. This lack of transparency makes it difficult for both foreign investors and Chinese citizens to make informed decisions, which further stifles confidence and investment. The global ramifications of this are profound. A severe economic slowdown in China would send a shockwave through global supply chains and commodity markets. Countries that rely on China as a key export destination, from resource-rich nations in Africa and Latin America to manufacturing hubs in Southeast Asia, would face a sharp decline in demand. The world's second-largest economy is not just slowing down. It is wrestling with deep-seated structural problems that challenge the very foundation of its economic model. Unlike America's debt, which is a symptom of political spending, China's debt is a symptom of a broken growth model, and that makes it a far more dangerous and unpredictable crisis for the world.